In the meantime, let's go to our featured guest of the morning. He's Colin Stewart, Chief Executive Officer and Portfolio Manager at J.C. Clark. First of all, Colin, thank you for being here.
Great to be here, Paul.
If the numbers land as expected, 2.7% down in each case on a headline basis and core basis, do you think this will be enough to convince the Bank of Canada to cut in 2 weeks?
I do. I mean, this is the last read before the Bank of Canada decision on June 5th, so obviously an important number. And I think overall we've seen a somewhat softening of economic and jobs data in Canada in recent months. And we've seen the 3-month rolling average on some of the inflation data starting to moderate. So I think the signs are there. And if this number comes in line or weaker and it isn't a hot number, I think that, will likely give the Bank of Canada the ammunition to sort of say we can, and the confidence that we can, cut 25 basis points. So just a modest cut, but the signaling I think would be taken well by the markets. It could be some talk that it's a boost for the housing market in Canada. People are waiting perhaps to see lower mortgage rates in this country. So it is an important piece of information, and as you said, the expectation is for a moderate weakening from where we were last month, and I guess we'll see.
If the bank does cut on June the 5th, does that issue in a period of sustained and regular rate decreases, or does the bank take its time in reducing rates? Yeah,
I would think that, most central banks, certainly take their cue to some degree from the Fed, and we've definitely seen that sentiment from the Fed in the U.S., taking that cautious approach to, I think most central banks are in the camp. They don't want to cut and have to raise rates again and sort of go back and forth. So I would expect, if we do get CPI data in line or softer today, you might see that 25 basis point rate cut. Then maybe there could be a wait and see period. So, I think it takes time for rate cuts or increases to work their way through the economic system. And I think the Bank of Canada, like other central banks, would want to see the impact of that cut. You don't want to see too much, speculation in the housing market or in financial markets as rates start to come down. So I think central banks, including the Bank of Canada, are going to be cautious as they sort of embark on those initial rate cuts.
Will there be any impact in the Canadian stock market to the interest sensitives, for instance?
Yeah, again, 25 basis points in the grand scheme of things, if they were to cut rates in June, isn't huge. But I think the signaling of effect of we're now starting to see rates coming back down could certainly be a positive for some of those rate-sensitive sectors, as you said, Paul. Things like utilities, REITs, dividend-paying stocks, companies that would benefit generally from a lower rate environment.
There's been a lot of talk about mortgage renewals that are due either this year or next year or the year after, and the pain that many variable rate mortgage holders will feel. The Bank of Canada must be obviously aware of that. How do you think that might factor into its decision? That's something the Bank of Canada would not likely explicitly acknowledge as a catalyst for a move, correct?
No, you're absolutely right, but I'm sure it's in the back of their minds. And I think, the corollary would be that, if they kept rates too high and you had all these mortgage resets or mortgages renewing at much higher rates, the pain that could cause the consumer in the future would, perhaps necessitate more rate cuts. So I think, the idea perhaps of getting out in front of that a little bit and helping ease that problem, as you said, I think it'd be highly unlikely they would explicitly acknowledge that, but I'm sure it's in the back of their minds.